Hello everyone, a very good evening. Welcome to Oliveboard. This is the CAIIB Foundation for June 2025 and we are covering all the units from the BRBL paper here. We are summarizing each and every unit from all the modules and today we are going to discuss the unit 24 from module C. This is the last unit from module C, the tax laws. All right, so all of these videos are very important for your exam point of view. So make sure that you attend these sessions and you understand these videos. All right, so when we talk about the tax laws, we have certain important taxes like the income tax, the commodity transaction tax, and the goods and services tax, right? Also, the banks and financial institutions are required to implement the provisions of the tax laws by, for example, deducting the taxes at source or by crediting the tax deducted at source to the income tax authorities. And they also have to comply with the provisions related to the goods and service tax in their day-to-day operations. That is why we are studying this chapter. So first we have the Income Tax Act. We already know that the tax structure in India is divided into the direct taxes and the indirect taxes. Income tax is a type of direct tax in which the burden cannot be shifted. It falls on the same person on which it is levied, right? So the Income Tax Act of 1961, it came into force from April 1st, 1962, and it governs the law relating to taxation on income of the individuals, the corporates, etc., on the basis of the residence and the place of source of income. So any individual who is a resident of India or a corporate who is a resident of India and their source of income is India, they will be taxed under the Income Tax Act. All right. So any the income will include the profit and gains, dividend, or any profit, right? When they're ordinarily residing in India. All right. If we are talking about the corporate society, so the profits and the gains of any business carried on by the cooperative society with its members, any winnings from lotteries, crossword puzzles, all of these things will be included when we are calculating the total income of the individual. So the income, now other important definitions, we have the assessee, the income occurring or arising to a person. So for that person for which we are assessing the income, calculating the income is the assessee, is taxed on the basis of assessment year. If you have followed the latest budget developments, you'll see that these terms, the assessment year, financial year, previous year, these have been simplified by adding the term tax year. So to avoid the confusion of what is the meaning of assessment year, how is it related to the financial year, simply we are going to use the term tax year from now. But in our syllabus, these terms are given, so we'll try to understand them as well. So the term assessment year represents the period of 12 months beginning from 1st April every year, and the income arising in the previous year will be assessed in the assessment year. So income that we are earning or the income that is arising in the previous year will be taxed and paid in the assessment year. So the previous year means the financial year immediately preceding the assessment year. All right. So if we are deciding on the assessment year for the or for the taxes to be paid in 2025, our previous year will be the financial year preceding the 2025-26 period. All right. If let's say a profession is newly set up or a source of income is newly coming into existence in the said financial year, then the previous year shall be the period beginning with the date of setting up of the business or the date the source of income newly coming into existence, right? And the previous year will end with the said financial year. All right. So this is how we are going to calculate the income in the previous year and assess the tax on it, right? Then when we talk about the residential status, so when we are deciding whether the income is taxable under the income tax or not, it doesn't depend on the nationality or citizenship. It depends upon the residential status of the assessee, which is determined on the basis of the number of days an assessee was present in India during the previous year. So, if in the previous year, let's say 2023-24, the person was present for 182 days in India and they are earning income from any source, that income will be taxed as per our Income Tax Act. In the case of corporates, it is determined on the basis of location of control and management of the company and also the place of registration. So, if any company is registered under the, let's say, Companies Act of 2013, then the corporate will be treated as the resident and the income will be taxed. When a company, let's say, is an Indian company and it is registered under the Companies Act of India, or if it is a body corporate set up by a statute or a company whose control and management is based in India, then the company will be treated as a resident in India. And that company's income or the profits will be taxed. All right. Then when we talk about the computation of income, the total income that will be taxed. So the Income Tax Act envisages the following heads. We have salaries of the individual, income from the house property, profits and gains from business or profession, any capital gains, short term or long term, and income from other sources. So what we are going to do, we are going to compute separately the income arising under the various heads as per the relevant sections. Then after computing the income, we are going to calculate the gross total income. After adding all of these, we will arrive at the gross total income. And then the Income Tax Act, as per the slabs and the cess, if any applicable, the given rates will be calculated. Now again we have the old tax regime and the new tax regime. Also the budget has introduced a completely new taxation, but we will study what is given in our syllabus. Now there are certain incomes which are not included in the taxable income, like foremost we have the agriculture income or any sum which is received by an individual as a member of the Hindu undivided family, which is paid out of the income of the estate belonging to the family, right? So these incomes will be excluded from the calculation of the total or computation of the income, right? Then the banks accordingly will see what is the TDS, how the TDS will be collected by the banks, and it will be transferred to the account of the authority. However, non-compliance with the provisions relating to TDS is going to have a levy, as well as the recovery of the tax deductible will be from the person who is responsible for the deduction. For example, the bank, if they omit and they do not deduct the tax and they do not transfer it to the government's account, then they will be responsible to pay. Also, the non-payment of the tax deducted at source to the government attracts the prosecution proceedings as well, and imprisonment from 3 years to 7, from 3 months to 7 years, right? So these are the provisions of the Income Tax Act. Then we have the Commodity Transaction Tax, which was introduced under the Chapter 7 of the Finance Act of 2013. It means the tax which is leviable on the taxable commodities transaction. So we are talking about the tradable, marketable commodities. So the commodity derivative can be a contract for the delivery of good. which is not a ready delivery contract or a contract for differences which arise from the prices and the indices, that is the derivatives. So any underlying good related activity, any derivative will also be included. And the taxable commodities transaction means a transaction of a, let's say, sale of commodity derivatives based on the prices. So on those sale of the commodity derivative, the commodity transaction tax will have to be paid. And in this scenario, the entity responsible for collecting this tax will be the recognized stock exchange. So the law makes the recognized stock exchange dealing in the commodity trading responsible for the collection of the commodities transaction tax from the seller who enters into the taxable commodities transaction at the rate which is specified, right? So the recognized stock exchange on which the commodity trading has been done, they will collect the tax from the seller. Then the tax which is collected during the calendar month shall be paid by the stock exchange to the credit of the central government by the seventh day of the month immediately following the said calendar month. So if the tax is collected in February, it has to be credited to the government's account by 7th of March. If, however, any assessee fails to collect the tax, shall be liable to pay the tax to the credit under the provision. So similarly, if for example under the TDS, the bank fails to credit or collect the tax, then they will be responsible. Similarly, here this recognized stock exchange will be responsible to make the credit to the central government, and the taxes, penalties will be applied as such given in the act. All right. Third important act is the goods and services tax. We already know all the indirect taxes that were earlier implemented. They have been replaced by the GST, which is a destination based tax. It is a destination based tax. It has simplified the taxation procedure, although it has certain deficiencies which are again discussed to be covered under the new budget in the budget session. So if we talk about the GST, it is one indirect tax for the whole nation under the One Nation One Tax, which was enacted on April 12th, 2017. So it is a single tax on the supply of goods and services right from the manufacturer to the consumer. So now the consumer will have to pay only the tax on the value added finally by the seller. They will not have to pay the tax at each and every level of value addition. So this is going to simplify the tax payment for the consumer. So the GST is levied under the state GST, central, and the integrated. So the GST levied by the center on the intra-state, that is between two states, supply of goods and services is known as the central GST. The GST which is levied by the state or the union territory inter within the state, that is known as the SGST or UTGST. And similarly, the interstate supply of goods and services will be the integrated GST. And on the imports as well, the integrated GST is going to apply. The integrated goods and services tax is going to apply on the imports as well. All right. So the GST is going to have the benefits for the final consumer, the government, as well as the manufacturer. The final consumer will bear only the GST which is charged by the last dealer in the supply chain, right? The central and state government will have easy compliance, uniformity of the tax rates, removal of the cascading taxes, right? This will also be the benefit to the business and the industry. This GST will be simple and easy to administer, and the government is going to have better controls on the leakage, high revenue efficiency, and so on. And that is all from this chapter. With this, we have finished the complete module C. We have finished till module A, B, and C, and only one module is left. Also, the CAIIB Super Elite all-in-one plan, the classes have already started. You'll get the live classes, mock tests, and notes, all the batches access under the one plan. And if you subscribe now, then you can use the code VDAY, which is the Valentine's Day special, and it ends on 16th of February. You can avail flat 49% off on your CAIIB subscription on the various batches and courses. So avail this benefit, avail the code, and start your preparation. That is all for today. I will see you again tomorrow with the next unit. You can download the PDF. The link is there in the description box. You can also find the link to the course and other details in the description. If you have any doubts, any queries, please let me know in the comment section. So, thank you so much and all the best.